Don't look now, but we are right there. You can feel it. The energy is different. The conversations are different. The tone coming out of Washington is different. Agencies are talking. Lawmakers are talking. The pressure is building. And whether you're holding XRP, Bitcoin, Ethereum, Solana, or you're just watching from the sidelines, this is one of those moments where you can sense that something is about to shift. The calls have been incredible. The engagement has been incredible. I'm hearing from people inside the community saying the phones are lighting up nonstop, emails flooding in, voicemail boxes completely full. They can't even keep up. That's not noise, that's momentum. And that's exactly what we need to keep pushing. This is not the time to sit back. This is the time to lean in. Call your senators, every single one of them. If you're Republican, call your Republican senators. If you're Democrat, call your Democrat senators. This isn't partisan. This is about clarity. This is about fairness. This is about reminding them who they work for, not Wall Street, not special interests, us, the American people. That pressure matters. They need to hear it. They need to feel it. And from everything I'm seeing, they absolutely are. The news flow today has been strong, stronger than we've seen in a while. And then you look at the market data and you start to see something else happening under the surface. Did you catch that move? Because that wasn't small, that wasn't random, that was what traders would call a God candle, a massive spike in probability. We're talking about a jump from around 60% all the way up toward 90% in a very short window. That does not happen by accident. It takes serious capital to move a prediction market, even 1%. And we're not talking about 1%, we're talking about a surge. Now, don't panic if you see it pull back from 90 to 85 or 86, 5 or that's normal. That's profit taking. That's how markets breathe. They expand and they contract. But the real question people are asking is why? What triggered that move? Did somebody know something? Did information leak? Is there insider positioning happening? You hear politicians talk about prediction markets and they get nervous. They worry about insider trading. They worry about information asymmetry. And when you see a spike like that, it makes you think early morning in DC, around the time staffers are already at their desks, working phones, reviewing drafts, holding quiet meetings, then suddenly, boom, the probability starts climbing 60%, 65, 70, 75, rolling higher and higher until it taps 90 before cooling off. That kind of move signals confidence, not hype, not retail frenzy, confidence. And even with the pullback, we're still sitting in the mid 80s. That is a dramatic shift from where we were not long ago. So stay focused, stay engaged, keep making the calls, because when you combine grassroots pressure with shifting market confidence, that's when real change happens. Very interesting chart to watch right now. I don't know exactly what flipped the switch, but something shifted. I had people texting me, emailing me, sending screenshots, asking what just happened. And I'll tell you this, when my phone starts lighting up like that, I know something is brewing behind the scenes. I've been digging all day, researching, calling contacts, reading between the lines, and everything I'm hearing, everything I'm piecing together, I'm going to lay it out for you here. That's why, if you're not subscribed, you are missing the research. I don't say that lightly. There is a lot of noise out there. There are a lot of hot takes, but very few people are actually following the legislative language, the agency statements, the market reactions, and tying it together in real time. So get in here, subscribe, hit the like button if you appreciate real breakdowns. Let me know where you're watching from. And more importantly, put FF down below for financial freedom. And if you actually called or wrote your senators like I asked, let me know that too. Ask them for a written response. They will respond. That's how this works. I felt like a civics teacher today walking people through it. And for those who don't know, I've taught statistics, finance, management, high school, and college level. So yes, I get a little fired up about this stuff because this isn't just charts. This is structure. This is policy. This is the future framework of an industry. Now let's talk about what I'm hearing. The biggest rumor floating around right now is that there have been high-level meetings. Not casual coffee chats. I'm talking tier 1 meetings, banks, crypto executives, regulatory bodies. I'm not sitting in the room, so I can't confirm it. But when markets start moving probabilities aggressively before headlines drop, you pay attention. I told you a long time ago I expected this to pass by April with about 80% confidence. I heard from doubters every single day when probabilities were sitting at 50 or 60%. Funny how quiet it gets when we start pushing into the mid-80s. No apologies, no knock-knock, just silence. That's fine. We'll see how it plays out. What I'm hearing is that There was a breakthrough on the 404 section, the stablecoin yield issue. That's been a sticking point. I was frustrated about it. I was vocal about it because it should have been addressed earlier. But here we are, and I'll say this from negotiating contracts for years. You cannot let perfect get in the way of good enough. This bill, even if it's not flawless, is light years ahead of chaos. Chaos is what we have now, guidance that changes with administrations. Enforcement first, clarity later. That's not sustainable. Codified law through Congress cannot be erased with a single executive order. That matters. And that's the piece a lot of people miss. If this stays in the realm of guidance, a new administration can come in, Republican or Democrat, and flip the switch. We've seen it before. That's not speculation, that's history. What we want is codification. We want Congress to put it in writing so it cannot be undone on a whim. Only Congress can change what Congress passes. Executive orders don't override that. And when you understand that, you realize why this moment is so big. Crypto is still new to many lawmakers. Some of them probably struggle to explain what a blockchain actually is. They've been dealing with traditional finance for decades. Then suddenly this digital asset ecosystem shows up, decentralized protocols, stablecoins, tokenization, and you've got 25-year-old staffers trying to explain it to people who built careers before the internet was mainstream. There's a gap there. But what they do understand is voters. They understand political capital. They understand money. And there is serious money backing pro-crypto legislation right now. If this bill stalls, if it gets watered down to the point where it protects monopolies instead of innovation, there will be consequences at the ballot box. You don't think lawmakers know that? Of course they do. They'll never say publicly that they're influenced by campaign funding. Politics is marketing, Republicans positioning as pro-crypto champions, Democrats aligning with banking stability arguments, red versus blue narratives. Meanwhile, banks are arguing safety, protecting grandma and grandpa's deposits. That's the line. But crypto has been around more than 15 years now. We haven't seen the catastrophic collapse they warn about every time innovation challenges incumbents. It's the same playbook used throughout history. Fear first, delay second, control if possible. Think about the horse and buggy industry when automobiles emerged. Think about ice delivery companies when refrigerators were invented. Entire business models fought to preserve themselves. They pushed narratives about danger and instability. That's what entrenched systems do. And now we're seeing similar dynamics with stablecoin yields and deposit competition. Banks don't want deposit flight. I get that. But there's a difference between protecting stability and codifying monopoly. We want a level playing field. Safety and fairness can coexist. They're not mutually exclusive. And from what I'm hearing, there's movement toward a middle path, conditional exemptions, allowing exchanges like Coinbase or issuers like Circle to offer rewards under specific liquidity requirements. That would preserve innovation without destabilizing banks. If that's true, that's a major breakthrough because it means passive income models don't disappear overnight. And here's the other big rumor. The highest levels in the White House want this done, not casually. Urgently. I'm hearing April 3rd as a target for signing. That's aggressive. That explains the full court press in DC right now. Agencies, committees, staffers, leadership, everyone pushing to align language and votes. Deadlines create clarity, and when government moves with urgency, markets notice. Let's talk about Project Crypto. I mentioned it long before it started circulating widely. People said they hadn't heard of it, said I was making it up, and now you're hearing senators reference it in sessions. That's not luck, that's paying attention to early signals. And part of that initiative involves what insiders are calling the list, the classification list, commodity versus security determinations. That's enormous because if certain major assets land on the commodity side, that shifts primary oversight to the CFTC instead of the SEC. And we've already heard from the CFTC chair that we are, quote, on the cusp. That's a bold statement from a federal agency. Agencies don't casually use language that can move markets. When they do, it's intentional. And if you classify a significant portion of the crypto market as commodities, you move oversight toward a regulator that historically has been more principles-based rather than enforcement first. Think of it like this. If the SEC has been the strict disciplinarian, the CFTC has often been the more measured referee. Codifying that shift would change everything. There's also talk of DeFi builder immunity. That's flying under the radar but could be massive, protecting developers who write code for non-custodial systems, encouraging innovation instead of scaring it offshore. If developers know they won't be targeted simply for publishing open source code, you keep talent in the United States. Add to that a 120-day review clock for applications, self-certification processes, clearer pathways for token launches, and even a $75 million exemption threshold for smaller capital raises. That lowers the barrier to entry dramatically. Instead of startups facing $5 million legal bills before they even launch, they get breathing room. That's how you build an ecosystem. That's how you compete globally. And that's why I keep saying this legislation, if passed in strong form, could be the most important financial innovation framework of the last decade. People who help push it across the finish line will be remembered, not because it's trendy, but because it sets the foundation for global dominance in digital assets. When companies know the rules, capital flows. When capital flows, innovation accelerates. But here's the part that confuses people. If probabilities are rising and rumors are positive, why is price weak? Why are we seeing red candles? Simple. Markets price certainty, not hope. Big money does not deploy billions on maybe. They wait for confirmation. And broader risk markets have been volatile. When equities sell off sharply intraday, leverage unwinds, crypto feels it, short-term traders de-risk, liquidations cascade. That doesn't negate the structural story. It just reflects current liquidity conditions. You saw it today. Equities ran up, then dumped hard, then bounced, then dropped again. That kind of whipsaw pressure spills into crypto. Add in leverage traders running 10x, 50x, even 100x positions, and volatility compounds. I don't play that game. 2 or 3 times leverage max, if ever, because leverage junkies amplify moves in both directions. So when risk sentiment shifts, they get flushed. That's what creates those sharp drops that look disconnected from fundamentals. But step back. Look at relative performance. Some assets are not making new lows even when Bitcoin tests support. That divergence matters. It suggests positioning ahead of potential catalysts. And here's how I see the sequence if this progresses. First, confirmation that committee votes are secured. That triggers an initial pop, maybe 5 to 10%. Then markup vote passes, bigger reaction. Then floor vote, momentum builds. By the time it reaches the president's desk, a lot of it is priced in. When it's signed, maybe you get a brief sell the news event. That happens. But over the following 12 months, you get structural inflows, banks freed from SEBI 121 accounting penalties because the repeal is codified into law rather than dependent on executive discretion. That's huge, because right now, even though prior guidance was reversed, banks know it could come back under a different administration. They need permanence before allocating serious capital. Codification removes that fear. Once that fear is gone, participation expands, and with clearer timelines, innovation accelerates domestically instead of migrating overseas. I'm even predicting within 12 months of signing, we see a major IPO tied to this ecosystem. That would reinforce legitimacy and draw institutional attention. But I'm also realistic. If this collapses at the last second, if banks dig in with red lines and Congress sides with entrenched interests over voters, that will be visible. People will know. And in an election cycle, that matters. Lawmakers understand that. They understand that voting against a bill framed as innovation, jobs, and competitiveness carries risk. So while marketing narratives will continue on both sides, the underlying incentives favor resolution. That's why I'm leaning optimistic. Not blindly, but based on incentives, momentum, and the tone shift across agencies. There's also the anti-money laundering provisions being negotiated, the ethics components regarding executive holdings. Those are real sticking points. Don't let anyone tell you everything is magically resolved. Politics is messy, compromises are layered, but the broader arc feels different than earlier deadlocks. There's urgency now. There's coordination between committees that historically moved at glacial pace. When I hear that senior officials across the SEC, CFTC, Treasury, and White House are aligned on timelines, that's not trivial. Agencies often compete. Turf battles are common. If they're moving in parallel, that suggests top-down direction, and markets sense that. Even when price dips, probability markets can rise because insiders understand process milestones. Now, about global dominance, this isn't hyperbole. If the United States establishes a clear, innovation-friendly, yet responsible framework, capital that has been waiting on the sidelines floods in. Developers return, startups incorporate domestically, institutional desks expand, pension funds gain confidence, and once that cycle starts, it compounds. Liquidity attracts liquidity, talent attracts talent. Contrast that with the alternative: continued ambiguity, enforcement through settlements, guidance shifting with administrations. That breeds hesitation. Capital hates uncertainty. It will go where rules are known. That's why this moment is so pivotal. It's not about a single token or a short-term trade. It's about whether the US leads or lags in the next phase of financial infrastructure. And yes, I know you're looking at your portfolio thinking it's red. I get it. I feel it too. But short-term price does not always reflect long-term positioning. Sometimes markets shake out weak hands before clarity hits. That doesn't guarantee upside. Nothing is guaranteed. But when you analyze incentives, legislative momentum, agency rhetoric, and capital behavior together, the picture becomes clearer. We are closer to resolution than we've ever been. And when resolution comes, it resets the playing field. Banks gain certainty, builders gain protection, investors gain transparency. That's the trifecta needed for sustained growth. Let's go back to the political calculus for a second, because this is where the real chess match is happening. And if you don't understand incentives, you don't understand Washington. When pro-crypto PACs start signaling publicly and privately that they are prepared to deploy serious capital behind candidates who support balanced, innovation-friendly legislation that changes behavior overnight, you don't have to like that reality, but it is reality. No incumbent wants to walk into an election cycle with a well-funded challenger running ads saying they blocked innovation, killed jobs, and sided with entrenched financial interests over emerging technology. That narrative writes itself. And in a tight race, perception is everything. At the same time, let's not pretend banks are sitting quietly on the sidelines. They are organized, they are influential, they frame their argument around systemic stability, depositor protection, and financial resilience. They warn about deposit flight if stablecoins begin offering attractive yields without guardrails. And to be fair, deposit stability does matter in a fractional reserve system. So the middle path on stablecoin yields becomes the pressure valve. If exchanges and issuers can offer rewards but must meet defined liquidity ratios and risk management standards, you preserve consumer choice without triggering destabilizing bank runs. That's not surrender from either side, that's negotiated equilibrium. And durable legislation is almost always built on negotiated equilibrium. Now layer in the role of the Commodity Futures Trading Commission. When the CFTC signals readiness to oversee digital assets that are classified as commodities, you're talking about a shift in regulatory posture. The culture difference between enforcement first and supervision first approaches is significant. It doesn't mean a free-for-all. It means clearer rulebooks, defined processes, and pathways to compliance that don't rely on retroactive lawsuits. Add 120-day review deadlines for applications, self-certification frameworks for certain listings, and safe harbor provisions that protect developers acting in good faith, and suddenly you have predictability. And predictability is oxygen for institutional capital. Pension funds, asset managers, and large banks don't deploy billions into environments defined by ambiguity. They need statutes, not speeches. That's why codification matters so much more than executive action. Executive orders can be reversed with a signature. Laws passed by Congress require Congress to undo them. Banks know this. That's why they are waiting for statutory clarity before committing balance sheet capacity at scale. Once accounting penalties like SAB 121 are permanently addressed through legislation rather than temporary guidance, custody operations expand. Trading desks allocate more capital, structured products become viable, liquidity deepens, bid-ask spreads tighten, volatility gradually compresses as participation broadens. This isn't about catching one explosive candle on a chart, it's about structural maturation of an asset class. That's why, even on red days, I'm watching committee calendars and legislative language more closely than 5-minute charts. Because when the vote comes and uncertainty collapses, markets will reprice rapidly. Whether up or down, clarity forces capital to move. And in financial markets, resolution of uncertainty is often the most powerful catalyst of all. So here's where we stand right now. And I want you to really take this in because this is one of those moments where a lot of moving pieces are converging at the same time. We are hearing credible rumors of breakthroughs on the stablecoin provisions, specifically around yield structures and conditional frameworks. We know high-level meetings are reportedly ongoing, not surface-level discussions, but serious negotiations involving decision makers. We have agencies signaling that we are on the cusp. That is not casual language. When regulators start using words like that, it means something is aligning behind the scenes. The White House is reportedly pushing for a defined signing window, not some vague sometime this year timeline, but a real date target. Classification lists are said to be nearing completion, which is critical because commodity versus security determinations reshape the entire regulatory map. DeFi builder protections are actively being discussed, which would protect developers and keep innovation domestic. Review timelines are being formalized so applications cannot sit in limbo indefinitely. Capital raise exemptions are being expanded to give startups room to breathe. And politically, incentives appear aligned toward resolution instead of endless delay. That's not accidental, that's pressure working. Now put that backdrop against the short-term price weakness we're seeing. It starts to look less like structural failure and more like positioning friction. Markets don't move in straight lines, traders de-risk, leverage unwinds, broader macro pressures spill over. That doesn't automatically invalidate the legislative trajectory. Could this still fall apart? Absolutely. Politics has a way of surprising everyone at the last second. Red lines can harden, compromises can unravel, personal agendas can interfere. But here's the difference now compared to previous cycles. Accountability is immediate. If this collapses because specific players blocked balanced legislation, voters will know, donors will know, the industry will know. Information travels too fast in modern markets for obstruction to stay hidden, and in an election cycle, that matters. My base case remains that we get real answers next week, not whispers, not anonymous hints, actual procedural movement, markup vote scheduling, committee confirmation, a visible step forward, something tangible that shifts this from speculation to process. And once that hits, markets will adjust quickly. The first reaction may not be explosive, it could be measured, but as each stage clears, momentum builds. By the time a final vote approaches, repricing accelerates because uncertainty collapses. Over the following year, assuming strong implementation, I expect meaningful capital inflow into the sector. Not irrational mania, not meme-fueled spikes. Sustained allocation, infrastructure build-out, institutional integration, that's the real vision here. Financial freedom in this context is not just price appreciation. It's access, it's transparency, it's participating in a system that isn't constantly at risk of regulatory whiplash every time administrations change. It's knowing the rules and building within them. So stay sharp, stay engaged, call your representatives, ask for written responses. Pressure shapes policy more than people realize. Markets may wobble day to day, but the structural narrative feels closer to resolution than at any point before. And when clarity finally locks in, you'll understand that this wasn't random. It was constructed step by step, negotiation by negotiation, until uncertainty gave way to law. And once law replaces ambiguity, everything changes.